great one to start in for beginners since you can realistically be competitive, albeit likely on a smaller exchanges with very little capital. I'd like to make it clear before we start that I'm not a developer and work as a researcher. This means I've implemented trading algorithms still, but my knowledge I'm sharing in this article today mostly revolves around tips and tricks I've come across along the way. I won't write the cleanest of code, although I hope to think it's not awful quality. And you certainly shouldn't take advice from me about data structures and algorithms, but there are certain tricks you figure out from observing what kills latency over the course of having deployed many algorithms and seeing consistent solutions. So API interaction pandas equals slow optimization IO. Oh snap, this is paid. It's paid. Okay. I'm not paying the guy right now. I'm sorry. Where will crypto go? In this much shorter than usual article, we will try to have a guess at where the market believes BTC and ETH will be going soon. Our analysis will be results focused on and in two follow-up articles. We will dive a bit more into ways to estimate this effectively. Um, let's see here. When I first thought about this topic, my immediate thought was to look at using the D2 of the options. Of the options to use the fit service probabilities for each. For readers unfamiliar with some of the math, it's this math where CS2T is the price of the call option, S is the current spot price, K is the strike price of the option, T is expiration time, T is the current time, R is the risk-free rate, B is the cumulative distribution function of the standard normal distribution.
Don't run with the pack. If everyone is trying to solve the same problem, or a whole group of people, if that's the latest and greatest thing to do, don't do that.
Don't do that.
Do something original. Don't follow the pack.
What's your thoughts on the new research paper published called Expected Political Outcomes in Currency Markets? I haven't read that. Oh, this article will tend to become a bit math heavy. It's option after all, but what really is worth understanding is the D1 plugs into CDF and gets you your delta, and if you adjust it for time and volatility, you get D2, or the probability of the option will expire in the money. We can see quite simply how D1 and D2 with a quick adjustment. I'm writing down questions right now. Aspiring quants can giving a basic code example here, so you can go ahead and make that math up there in the code, not too hard, which produces this plot here. Implied probability density function of price to expiration. We do a few modifications to this as we then also look at the probability that the price will end up with 100 within 100 and 1000 of each strike for ETH and BTC respectively, but I will touch on this in a later article. Improving on this, it's not a terrible method for estimating the probability that prices will be within the X amount of strike, but when it comes to uniform distributions, we get a pretty terrible job. That said, we do capture bumps in the curve, which I personally think are valuable. For the sake of uniformity, We will assume a log normal distribution and weight by the bid-ask spread. Absolutely. Shoot me links, bro. Shoot me links, dude. I'm always interested in learning more. There's some earlier computation here, but this gives us the below plot for 31st of May 2024. This isn't so presentable, so we will of course add a bit of fun to the plots and show it all the next section. Alpha Academy. Thank you, dude. Is there a Dropbox for white papers like this? Quant Secret? Nice, dude. Thank you. Keep sending them. This is algos.org. I'm reading through this to see if we have some good questions for Homeboy. Um, yeah. What the market thinks. Here's our probability distributions estimated from our more naive approach to things like plainly uses D2. Okay, so he's using options here in crypto. These plots are nice and all, but they don't tell us an awful lot in intuitive terms about where the price will go. So it isn't easy. So it isn't so easy to visualize. Probability BTC is within 1000 of strike price across expiries. Plotting our mixture model approach. Yo, thank you, Rando. Thank you, dude. I'm gonna look at all these. I'm gonna put it all on a sheet or something. There are many caveats to note here, and they really should not be ignored. The first is that we do not believe that the market implied volatility will be the realized volatility of the market. To estimate this, we would need to do work on estimating the realized volatility against the market's implied over time and infer from this a rough guess of the true implied distribution. The distributions also had very fat tails because we have out of the money options which are not being weighted down in their presence. We can see below how illiquid options form a large part of the curve. We would be better served by fitting a least squares spline and weighting by bid-ask spread in our distribution. This is algos.org. Algos.org. Least square splines will tend to overshoot with sparse data, however, and so we would prefer to use Fengler's method, which preserves convexity and monotonicity of the implied volatility surface. I'll demonstrate this some other time. There's much more on this topic and many methods exist. Log normal mixture, stochastic collocation, Andreessen Huge, Butterfly's method, Breeden-Litzenberg. These methods are often used by real practitioners. We'll dive deep in a later article. In the meantime, feel free to check out this prior article where we dove into splines for options with a focus on market making. Algos.org, dude. Small trader alpha, perpetual arbitrage. Okay, this I like this one. The most liquid way to trade in digital assets is through the perpetual markets. However, they're not precisely the same instrument, even if they have the same ticker. So this adds quite a bit of complexity to the equation. We'll tease some P&L. This is one coin only between two exchanges and top of book. The shape is the part to focus on. The scaling part is trivial. Nice, dude. This looks great. Mid-price spread here. Okay, index, introduction, index, part one, basics. Overview of perpetual stablecoin basis, normalization of contracts, implementation, data scraping, pre-processing, checking for opportunities, taker back test. Part three, advanced trading, maker taker execution, volume and lead lag, latency, mean estimate, Conclusion. Basics to start with, it's worth mapping out the trade and how to achieve a simplified version of it. These don't work so well in the modern market, although they did previously. But that's why we have the advanced trading section to get readers up to speed on the state of the art overview of perpetual exchanges. Like most of the trades we've covered, perpetual arbitrage has a statistical element to it. In fact, it's not even technically a pure arbitrage and is counted as a statistical arbitrage, although it relies on mechanical forces which pull assets back together. Unlike a purely statistical trade, here are effectively betting on the convergence of two perpetual contracts likely cross-exchange. It mimics pairs trading in the regard that we have some entry threshold for the spread and an exit thread, usually the mean. And similarly, we use methods from pairs trading to time this spread. In the below sketch, we can see the cross exchange prices of two Solana perpetuals on different exchanges. So cross exchange PXs of Solana perps. Can you explain? Sure thing. The Orc Wing model and the SSVI model are both popular methods for fitting options in cryptocurrency markets. There you go, dude. After seeing this, give the fellow a shot. Hear what he's all about, Mr. B. Skipster says. Uh, One, how have previous. I'm going to go ahead and copy this question. Put in all your questions you have for Homeboy. All your questions you have for Homeboy, and I might bring him on. I might bring him on, dude. I want to keep reading through some of this stuff with you, and if you have questions, just throw them in the chat. Give the fellow a shot. Hear what he's all about. I want to hear your questions, dude. Mr. B, thank you, dude. Throw your questions in. If we get enough questions, I'll bring them on. If we don't have enough questions, I'm not gonna bring them on. I'm not gonna waste our time. How have previous experiences with the options trading influenced the author's current understanding of market dynamics? Okay. I'm gonna list all your questions and we'll try to get all of them answered. Any info would be great. Which site? This is algos.org. Thank you so much for all these links, dude. I'm gonna save all of these here and read through, or not read all of them, but
No, it's what's
skim
called
them.
machine learning.
See which ones are dope.
So you find things that are predictive. You might guess, oh, such and such should be predictive, might be predictive, and you test it out in the computer, and maybe it isn't, maybe it isn't.
Maybe it
you
is,
test
maybe
it
it
out
isn't.
on long-term historical data and price data and other things, and then you add to the system this if it works, and if it doesn't, you throw it out. So there aren't elaborate equations, at least not for.
Three things that are important to notice are perpetuals use different quoting assets, USD versus USDC. The OKX perpetual trades consistently higher than the Binance perpetual. They are strongly tied to one another. Our first and second observations both tie into each other. The consistency in the price difference can be any of the three causes: stablecoin differences, USDC, USD, structural differences, contract differences. With stablecoin driven differences, we can easily adjust by tracking the prices of different stablecoins, and with contract differences, we can investigate how different the contracts between two exchanges are manually. We will explore the contract normalization as a topic soon. Finally, our differences may be entirely structural and related to the specific flows that occur on each platform. Whilst theories as to many vary, it's no secret that certain exchanges simply trade higher relative to others, likely because of how their indexes are constructed. There's also differences in their basis volatility due to how the indexes are constructed. A good proxy of this for this is the closeness to a total share of total market volume that the index covers. An index made of Bybit, OKX, and Binance will be very stable. But if it's driven entirely by an exchange's own spot market, especially a smaller exchange, when we divide the two assets by another, we get the spread ratio. This is useful for timing as it's a lot more normalized between assets, but is not directly tradable. Trade opportunity here, spread ratio. Okay, so when the spread ratio has an anomaly, that's the trade opportunity. Okay. What we can actually trade is the difference, where we subtract the price from of one asset from another, stablecoin basis. As we touched on earlier, the first step of normalizing our spreads is to account for stablecoin basis. The price of stablecoins, much like the perpetuals, varies by exchange, so we need to normalize based on this. If the exchange has the stablecoin market pair listed, then it'll be best to use this. In the event of depegging, we will want to switch off the system, so it's critical that the system has an edge ratio scenario for this. Otherwise, we may end up betting on the debag due to large discrepancies in stablecoin prices cross exchange. This is not because the debag will cause the prices to be different, since we would, of course, have adjusted for this, but because during a depeg the prices vary drastically. We can look at Coinbase, which got a low of 93 cents on the dollar when USDC depegged, whereas the other exchanges only depegged for a few cents. KuCoin also depegged a lot more than others. Hence, unless we adjusted for the exchange specific prices of stablecoins, instead of trying to apply some global price, we would have seen a basis between perpetuals that was a bet on USDC. Even if we did manage to adjust well, there's a good chance we would have still needed to monitor the system because of the significant variance introduced by the stablecoin basis. It's also worth remembering that some exchanges will write USDC or USD on the ticker symbolism, but when you read the documentation, are marking it against USDC or USDT. There may also be USDC, USDT, and USD perpetuals for the same asset on a given exchange, and you can usually use the ratio between these to get an idea of the exchange specific rate for stablecoins. If one is not present, you can only use this proxy if the contracts settle the same way and have the same funding payment specifications. They don't always. Sometimes the USD ones are coin margined, and I've seen coin margined have different funding intervals to stablecoin margin perpetuals before. Normalization of contracts, converting perpetual prices from one venue like Binance to another, such as Bybit, OKX, or Hyperliquid, is complex. Using Binance's perpetual prices directly is not optimal, especially for platforms with shorter perpetual durations, like hourly ones on DEXs. This is because perpetual prices tend to converge towards the spot price in a pattern that resembles descending stairs until a funding payment occurs, which then causes a jump. We don't want to make trades that get us into a bad position on funding payments. An alternative approach of relying solely on spot prices is also flawed. It may lead to imbalanced positions favoring underperforming coins while shorting the surging ones. A potential solution is to clean the perpetual prices from a platform like Binance by accounting for accrued but unpaid funding payments, adjusting for rate differences, and then subtracting the accrued coupon for the specific platform you're converting to. This method is only moderately effective due to various challenges. Different indices used across platforms can lead to discrepancies, especially during volatile market conditions. There are limits on how high funding payments can go. which vary by exchange. Funding rates change frequently, affecting the conversion due to the nonlinear nature of the common funding formulas. Practical implementation issues such as determining accrued funding payments and adjusting for rate differences, considering the intricacies of funding rates formulas. The closest approach to a practical solution involves taking Binance's perpetual prices, adjusting the accrued funding payments and rate differences, and then recalculating the funding payments. However, there's no one size fits all formula for this, and you'll turn off specific exchange pairs or increase their entry thresholds in your system to try to counter this. An effective strategy involves analyzing data to understand how funding payments evolve relative to premiums and devising cross venue adjustments based on empirical evidence. This should include models for predicting how spot prices will converge across different venues. These are mostly driven by relative volumes on each exchange. We want to remember the notion of confidence throughout. If we deem two perps to be very similar, we can give a higher confidence to it and then size up on a divergence to a greater extent. How that score is developed is up to you as the reader, but generally it should include components like interval index formula, funding limits, and accrual formula. In any of these trades, the funding rate can play a significant role in divergence if contracts are misaligned. Thus, we should take these into account for our final live version. Entry exit timing. Timing our entries and exits for most firms is a simple moving average or perhaps even an exponential moving average with a set look back period. This look back period can be equated between the parameters for an SMA and EMA formula below. In addition to this, we have a parameter typically with a value of 2 to set the number of standard deviations from this threshold that will enter into a trade with a baseline assumption being that we exit when the price reaches the mean. We do not have to exit when price reaches the mean and can instead exit earlier. As we can see in the above diagram, the expected mean reversion between T1 and T2 written EM R T1, T2 in our diagram is proportional to the absolute z-score of the spread. The expected mean reversion roughly says how much we expect the absolute z-score to decrease by towards 0. Between two different time steps, I've drawn the relationship as linear, but it could be exponential or plateau out at a higher score, maybe even going negative, likely due to liquidation-based momentum caps on funding rates that you'd see these effects. We'd need to look empirically to see the true relationship, but the general idea stands for now. The issue is that the volatility of our spread can roughly be assumed to be constant, if anything. It is proportional to the absolute z-score, but let's call it a constant because it's an acceptable assumption for the explainer. The expected mean reversion is our edge. So we have a ratio between our edge and the volatility. As we see more of a reversion, the edge shrinks, but our volatility stays the same. So we get a worse risk reward ratio as the spread reverts. When we add in the risk of mean estimation errors, differences in moving averages,
make
parameters.
A choice, right? You just decide what it's going to be, who you're going to be, how you're going to do it. Just decide. And then from that point, the universe is going to get out your way. It's like it's water. It wants to move and go around stuff, you know.
Yo, keep the questions coming in, dude. If we get enough questions, I'll bring Homeboy on, but if we don't, then no way. It starts to become questionable whether we should hold entirely to the mean or exit slightly before. Thus, we have a third parameter, our exit z-score. It is worth noting that these trades compete aggressively on the ability to beat fees, costs of trading. We could end up tying up capital for ages, sure, but we also could end up giving a couple extra BPS that mean the world to us when we're only working with a few bips after transaction costs in all likelihood. I write this all down so the trader